Well, thanks so much for tuning into Talking Point. I'm your host, Neeraj Shah, and the Talking Point today are the views of Sanjay Mookim of JPMorgan. They've, I'm sure, now gotten enough time to reflect upon the budget and their own note that they would have come out with. The question is not just really about what the budget did, but more importantly, the budget and the global externalities. What do they mean for Indian equity markets? Sanjay, great having you. Thanks for joining in. Hope all is safe.
Good morning, Neeraj. It's always great to be on. Yes, all okay. Thank you very much.
Now, the pleasure is ours, Sanjay. So, Sanjay, let me start off with the budget and then move on to the other things. Clearly, the bond markets, because of the borrowing calendar or otherwise, or the borrowing program or otherwise, were a bit disappointed or a bit spooked, and it showed in the reactions. The equity markets seemingly thought was a non-event, aside of the Capex uptick. But even that is now being questioned about the actual numbers and the effectiveness thereof. What are your thoughts on the big B?
Okay, so let me take a few minutes to talk about those, Neeraj. One, the government has had a very clear message in this budget, right? If you step back from the number work for one, the message has been very clear that we are a growth supportive government, in that the framework of the budget is to try and invest to have the output gap close as rapidly as possible. And the government's done this at the cost of printing higher fiscal deficit numbers, at least for forecast. And I'm using those words carefully. So the policy choice is extremely clear. Capacity creation, long-term infrastructure build over income transfers or welfare support in the near term in order to address whatever weakness lies in the economy today. And you can argue that economically that's a good thing because these things have higher multiplier effects and so on. The second key theme in this budget, which I would like to emphasize, is that the numbers are still reasonably conservative, especially on the revenue front. I have argued that the math clearly suggests that the government is likely to exceed the forecast revenue collections, not just for FY22, but for FY23 as well, by a significantly large amount. And that realistically, the deficit for government is still likely to come in lower than they have projected. For both this current year, less than 6.9, and for FY23, possibly less than 6.4 as well. What does this achieve, right? And if you think about it, why would you do that? And it does kind of set up the concept of under-promise and over-deliver, right? For the government to say that, look, we've gotten everybody accustomed to this notion of a 6.4% deficit. We know that revenues will likely come in higher. Yes, there could be some higher costs given the global uncertainty and so on. But I am very likely to undershoot that number rather than to deliver a negative surprise to markets thereafter, right? So it creates this optionality. And if I may belabor the point a little bit, Neeraj, let's assume that the global external environment becomes more volatile because the Fed is tightening and you start to see dollar outflows out of EM. The government could very happily use those additional revenues and deliver deficit lower than forecast and say, look, we've taken cue of what's happening and we are cutting our deficit as a result. But if it didn't, and if the let's say the external accounts remain stable, then you could take that additional money and spend. And therefore, this creates an optionality, and you're not committing yourself to what you're going to do in FY23 with the revenue that you will get. It may be a good strategy given the uncertainties that lie outside.
Yeah. So the point about the revenue conservativeness is obviously very well taken. The question around the reaction that the bond markets gave to the borrowing program and the fact that this point that I was making with somebody yesterday, that with the nobody's fault, but really with the large portion of the non-discretionary part of the expenditure of any government at the center, it certainly seems that the borrowing calendar on the borrowing program would be a cause of concern. Do you reckon that the bond markets have fully priced that in, or could these change as the times go by and increase as the time goes by into the year, even if the revenue numbers were to expand from what they have been budgeted for right now?
Okay, I'm not a bond market expert here, but for what it's worth, I'd suggest that this is going to be a relatively more volatile year for rates markets, bond markets than it was possibly last year. And this starts with the premise that the Fed is going to have 5 rate hikes and more importantly, have balance sheet tapering. To to see quantitative tapering as well. And this will lead to increased cost of capital in EM. It's almost a given that you will see dollar costs go up across emerging markets, including in India. Okay. So my suggestion is that, look, yes, the bond markets were a bit concerned by the high print on the fiscal deficit, and more importantly, how that deficit is going to be financed, what is the net borrowing number, how much of the deficit comes to the market, how much of it is financed. Otherwise, those intricacies also matter. And I suspect the bond market was looking for a lower number of net borrowing next year than what is currently being proposed. Okay. And that does lead to this reaction. We're seeing 10-year bond yields almost at 7% right now. But my suggestion is that simply on the budget arithmetic, maybe this is an overreaction. Maybe that, bond markets have moved too much. But there are other reasons for bond yields to be higher through the year, right? The budget is just one part of the equation in my mind. And you might see external forces drive that yield complex a little bit more,
Okay. So my next question is also tied into the yields, but I'm not asking you to comment on the yields. My larger question is that if indeed the externalities are a bit more severe on the global front, but on the internal front, if the housing capex, which is already underway, the additional capex, whatever the number is, and people may squibble over it, but it is a number nevertheless, northwards of 15% safely, under 35%, what have you, between 15 and 35, whatever it is, right? So housing plus the other capex that the government puts in, some of it may be in housing again, but the other factors at play, enhanced revenues from tax collections, if you will, if all of them come to the fore, and if oil kind of recedes in the second half of the year, are we entering into a bit of a possibility of a virtuous cycle for India? Whether it's long-lived or short-lived is a separate question altogether.
Well, the answer, Neeraj, is yes. I think if you refine the question and say that this positive cyclicality is possible in the next 6 months, then it becomes a more difficult question to answer, right? Yes, the cyclicality should be key, especially if oil prices remain behaved. And let me just also point out that, if over the last few years, the shift in the government accounting, right? Because we always used to, as analysts, look at how much expenditure is under book, how much of it is off balance sheet, how much is hidden liabilities for government. All that has been cleaned up. So the true capacity of government to actually spend has gone up dramatically because of the last 2 years of this cleanup activity. So should you get a benign external environment, their capacity for government to actually spend and execute is stepped up. Okay? You may talk about execution constraints now. Okay, look, how many kilometers of roads can you actually build in a year? And those may become constraints going forward rather than to say, is there money available for it now? So to my mind, there is a path for the cyclical recovery or an endogenous recovery to kick in because we have a lot of favorable long-term dynamics, and I can talk about that. But do I expect this to show up in a big way in the next 2 or 3 quarters? That's where the debate becomes a little bit more confusing.
Got it. Okay. So before you talk about those factors, just one more question. Because optically there wasn't too much emphasis on or impetus given on consumption this time around, near term or medium term, you could argue as well. But there is a capex-led recovery that the government seems to be wanting to follow. Does consumption-led recovery, which is always kind of, you could argue, bailed India out in the past, does that take a back seat? And therefore, could this be a bit more of a stretch recovery in that when it happens, it will be great, but it's difficult to predict because there are no near-term triggers to this recovery?
Yes, I would characterize it as that. And look, the weakness in consumption here is no longer a forecast. It is now visible in companies' numbers. It is visible in management commentary. And I don't think we're getting too much pushback anymore to say that when we say that demand is weaker than expected. Now, to think about why this is happening, it is the shock and the scarring that Indian households have been through 2 rounds of lockdown for 2 years now. And while it is, perhaps fashionable to talk about pent-up demand and savings, those have occurred only for the top 10 or 15% of Indians. The bottom 80% of Indian households have actually had lower savings, greater income uncertainty, and lower incomes as well, perhaps through the pandemic. So what needs to happen is not just restoration of income, not just for that migration from rural back to urban, but also a restoration of consumer confidence. And that's what's going to elongate the process of recovery to my mind. Because merely the restoration of income does not immediately restore confidence, especially in an environment which is considered very inflationary, much more inflationary than it used to be. So the hope was in some quarters before the budget that the income transfers that will happen will lead to a quick reduction of this confidence and a quick revival. That is not happening. So now you're looking for activity creation, you're looking for income generation, then confidence improvement, and then maybe a consumption recovery starts. So again, like I said, this is not something that happens overnight. It will probably take 3, 4, 5 quarters for this situation to fix.
Okay, so in which case the factors that you mentioned lead to the other end of this equation to actually do well. I would reckon some of them were already in play and some of them will come into play as time goes by.
Yes, so if you're talking about Capex, there again, we have, it's great that the government's focused on, like I said, capacity creation and on longer term infrastructure, which will drive the productivity gains in the economy, right? And rather than just income transfers. But again, we need to scale it. And that's where the excitement becomes a little bit tempered, because of the total Capex that occurs in India, and India has about $1 trillion of Capex every year, give or take, more than half of it happens at corporates. 30% is real estate. And government is broadly anywhere between 15-20%. So the impulse that you get from government is a starter to other Capex cycles. It is not in itself sufficient to suggest that the entire Capex complex in India is going to revive imminently. Right? What we expect is that this construction activity will create demand for commodity, for cement, for steel. That drives corporate utilizations up, and then that drives a Capex cycle as well. So it is good, but is it sufficient again to drive very strong Capex in the near term? Not really. What will kick in, what will matter a lot more, to my mind, is actually real estate activity, which is much bigger than total government Capex all put together. And if that momentum continues, that's where the rate discussion becomes very important, because mortgage rates being at 20-year lows are a big stimulus to real estate. And if that starts to go up, it will be a problem. But if the real estate momentum continues, I would be more excited about Capex from that quarter than simply the infrastructure bill that the government announced.
So are you worried about real estate rates going up absolutely, or are you worried about not real estate rates, sorry, interest rates moving up absolutely? Or are you worried about interest rates moving up too fast, too soon? If they move up gradually, is that okay and palatable? Or even that will create a problem? Because circa between 50 to 100 basis points, sometime over the next 18 odd months, seems to be a near certainty, so to say.
Yes, I would agree with that. But what matters more to my mind for this decision of asset allocation is real interest rates, not really nominal. If you look at EMI payments on a mortgage, the sensitivity to interest rates is modest. So if, let's say, mortgage rates go from 6.4 to 7, I think borrowers will be able to accommodate the increase in mortgage monthly payments on as a consequence. But it's the real interest rate which drives the asset selection more important. When you find that the money lying in a debt fund or in a bank account is in effect eroding, that's when you find the impulse to go buy a house, buy assets, I mean, like equity assets right now doing well. And that shift, I think, is if RBI is willing to maintain negative real interest rates for longer in the economy.
So how does this set equities up? Because until now, they used to benefit from the TINA factor. In effect, by virtue of the taxation on crypto, that case, at least the competition from crypto and others might ebb a bit, but the fixed income competition might come back in some sense. And of course, rising yields and rising interest rates do impact valuations. So how do you see all of that stacked up for 2022?
Okay, so I would suggest that the budget, as you said initially, is probably will quickly become a non-event for equity markets. And the equity index will keep ebbing and flowing with the external tides. So the S&P goes up, we'll have a support to Nifty or MSCI India and conversely as well. And therefore, from an index point of view, I need to worry about the Fed tightening, the QT, and all of that applies equally to India. The problem is that bottom up, I have argued that the Indian upgrade cycle that we saw early last year is over. It is actually over in numbers as well. Coming out of the pandemic, we saw lots of earnings upgrades. Companies handled the pandemic better than anybody expected. But now we're catching up with base effects, and suddenly the growth rates are dropping because of arithmetical denominator issues and a generalized weakness in consumption. So from a portfolio construction point of view, while I don't argue that these downgrades will lead to the index volume, but that depends on what global equities do. But equity performance should continue to narrow, right? Especially among the large caps, where only a fewer sectors or a few companies will be able to meet or meet expectations. Breadth in the market narrows in as a consequence of the weaker economy, the weaker earnings delivery by this company. The other point you made on the retail participation implicitly, Neeraj, that I think continues until you get a price shock. Because at the moment, it's become self-reinforcing. Every dip has proven to be a buying opportunity. And until that premise is destroyed, I think retail participation in equities will continue.
Yeah. Okay. So, Sanjay, rarely do consensus calls work very beautifully. What I'm seeing over the last 30 odd days is that almost everybody who is in and around the pedigree of your esteemed house seems to be in a consensus that it is Capex related stuff which will do well. The index would meander here and there, but specific pockets would do well. And Capex related plays, maybe banks and industrials might do well, but external facing sectors, to an extent, consumption might suffer a little bit, save for autos, which might come back because they had a horrible 2021. Almost everybody is in that camp. Are you as well, so to say, kind of echoing these thoughts, or is your thought process slightly different between the winners and the losers?
So the answer is partly yes, Neeraj, and I'll tell you why. We are less enthused about the Capex complex than perhaps consensus might be, right? Especially, we argue that the industrial Capex cycle is going to take a while to recover, and maybe we can look at infrastructure stocks, but some of the other Capex might be a little bit early to get excited about. So that's one. But the problem in portfolio construction now is that if you actually go bottom up, you have problems with every sector, right? And the consensus actually arrives at financials and autos simply through a process of elimination. You look, okay, what is it I don't want to buy? And then what's the bottom list of the do not buy thing? And banks, okay, valuations are relatively okay, the earning momentum is fine. Autos, for exactly the reason you said, that they've had such a bad 3-year history that there's only one way to go from here, and you can only see improvements in volumes here on, hopefully at some point. So that hope trade in autos, the TINA trade in banks, in a way, makes every sell-side portfolio look exactly the same.
It does. So I'm just trying to understand, Sanjay, therefore, and not for the sake of trying to sound different. I'm just trying to understand, where is it that you might have the strongest conviction in such a arguably volatile year, presumably volatile year or probably volatile year? Where is it that you have the strongest conviction and why?
Okay, so our 2 or 3 things that I think will work is first the style of having a narrow portfolio, right? Instead of broad basing and having, let's say, 50% of the fund in mid caps because they're all doing very well and stocks are going up 10x in 10 days and all that. That momentum should fade, given the fact that valuation premiums in mid caps are very, very high, and more importantly, I don't think the earnings are going to come. Just to kind of respond to an earlier comment you made, Neeraj, consensus rarely works as far as, let's say, consensus earnings or downgrades or upgrades do not tend to predict nifty movements, right? So for 20 years, India has seen downgrades, but the market's only gone up. But they work very well on single stock basis. If a company is not delivering earnings or not delivering positive surprises, then the stock does not work most of the time. That's also not a 100% correlation, but most of the time. Right? From a stock selection point of view, we've argued that it is fairly clear that we're now into a cycle of disappointing earnings, or very likely. And therefore, a portfolio should become narrower and less mid-cap in allocation. That, I think, will work reasonably well. And sorry if I make a cliched anecdote, that's exactly what happened in 2018 after a very strong 2017. We had 40% mid-cap rally, 30% large-cap rally. But in 2018, only the portfolio which had 10 stocks outperformed. You had 11 stocks which underperformed the market. So I think markets will be driven by on level by what happens everywhere else. But the style internally will be driven by the earnings stability.
Okay.
Now, therefore, from an earnings tracking point of view, we are very underweight in consumer space, significantly underweight in consumer staples. And by process of elimination, the banks which are delivering earnings and valuation still look acceptable are a big overweight.
Got it. Okay. Okay. So that's one. Thank you for that. Thank you for explaining that as well, Sanjay. Just take a couple of more questions before we let you go. The other big debate is what happens to some of the new names that came into the market in 2021, right? The tech, whether it's consumer tech, whether it's fintech, but essentially the platform-based companies which have now carved a niche of their own, and all of them are substantially off, or most of them are substantially off from the highs that they made. And I'm sure it's a bottom-up strategy out here again, but I'm just trying to understand what's your larger, broad canvas on these.
Okay. So let me make 2 or 3 comments on that basket. One is that the potential for some of these businesses to be much larger in 10 years in India is there, right? And some of, as we've seen happen in many other countries, they can scale up revenues, they can scale up customers, especially as per capita income rise, and India gets to $4,000, $5,000. The total addressable market, the profit pool of these will go up. But what this also means is that the cash flow duration of these stocks is super high, because all the cash flow is back-ended. You're not making any money today, you're losing money now, but you may make money in 2027 or 2030 or thereafter. Therefore, the interest rate sensitivity of high duration stock is very high. And that's the reason that we have seen the correction in this. Because not because they've disappointed on execution in 1 or 2 quarters, it's because of the rate sensitivity, the assumption that rates are going up. High duration stocks are taking a beating everywhere in the world, and they're taking a beating here in India. The last point I do want to make on the Indian, let's say, techie platform is that, in my opinion, they might have IPO'd a little bit sooner than they perhaps should have. Okay? And if you take, let's say, the China example, most of the companies IPO'd when Chinese per capita income so much higher, right? So they were able to deliver profits within a couple of years of IPO and grow that profit very aggressively because the economy got big. We have IPO'd when our per capita GDP is $1,000, right? The duration of time taken to $1 billion EBITDA or $2 billion EBITDA is going to be much longer. So public market investors in these companies will have to wait longer for cash flow than they did perhaps in China. And that makes it a slightly more tricky situation in India.
Suffice to say that you may not be a big overweights into those even after the corrective moves. Okay. Last question, Sanjay. A lot of your peer notes that I have read, there is in some spaces a bias towards value, oil and gas, for example, some others. Can you talk a bit about that?
Okay, so as of now, value has been working globally simply because of a growth level. Right? Growth stocks, which are again high duration stocks, I think multiples go down. As a result, value stocks are going up. But the big difference in India as everywhere else is that everywhere banks are value stocks. Right? So when you tell an investor go buy value, they know what to buy. They'll go buy a big bank in the US. But in India, banks do not qualify as value. And what happens is that the value basket in India becomes very PSU oriented or very utility driven. And there, the only argument to make is a valuation. You don't have an earnings growth figure on top of it. And that's why to argue that in India you should shift dramatically to value is actually very difficult to execute, because there's not that many value stocks worth buying.
Yeah, no, but selectively, I mean, for example, Pinakin's notes on oil and gas by virtue of your global assumptions on oil prices and therefore the earnings growth on the upstream names, or for example, how correct you guys were on the metal names when you guys came out with those notes. You know, for example, just enumerating a couple of them. Are there value names, even if they're in the PSU space or otherwise, selectively that you guys may be bullish on even now? Because value too is inched up a little bit, right? That's why I'm asking this question. 6 months out, it was a no-brainer. Maybe not now. Just trying to understand.
So you're right. So we are seeing some, and again, that argument, Neeraj, is not because of the PE of the stock, but because there's a business cycle coming.
Okay.
The earnings momentum coming through because refining margins are going up or because oil prices are going up. That becomes the reason you're looking at the stock, not because it looks cheap on a day sale, right? So I do agree that markets have for some reason been ignoring these cycles, especially let's say the refiners, but it's again a cycle view, not a value style view.
Okay. Yeah. Okay. Thanks for making that distinction. Very important. Great. Sanjay, great having you. Thank you so much for spending the time today and talking to us. And of course, look forward to having more of it.
Always a pleasure.
Thank you. And viewers, thanks for tuning in.